Hello, my name's Rachel and welcome back to my channel. So today I am going to be talking to you about my thoughts on buying premium bonds or investing in the stock market. So for both premium bonds and investments, you can start investing from as little as £25. So which one should you choose? In today's video, I will be talking through three major points, and they are rate of return. So what can you expect to get from these investments? The second point is how long will you be holding these investments? And then the third is how much can you actually put into these investments and what are their allowances? And then at the end, I will share with you exactly what I am doing with my investments and premium bonds too. So first of all, let's look at rate of return. So when you're choosing where to save or to invest, your rate of return, or how much money you can expect to get at the end of your investment period, is probably one of the most important factors. So what I'm going to do here is talk you through investing £1,000 into premium bonds. Where would you be in 5 years' time? Investing £1,000 into the S&P 500. Where would you be in 5 years' time? And investing £1,000 into an investment that I personally have, and where would you be with that in 5 years' time too? So starting out with premium bonds, the annual prize fund rate is 1%. And if you invest £1,000 into premium bonds, leave it there for 5 years and have an average rate of luck, you'd expect to make around £50 at the end of your 5 years. So this is obviously a 5% return on investment over 5 years. So moving on now to potentially investing in the S&P 500. So I'm going to give you the figures here now for VUSA, which is the Vanguard S&P 500 ETF. The annualized rate of return for this investment is 15.03%. So if you invested £1,000 into Vanguard's VUSA or VUSA 5 years ago, you would have potentially made an additional £1,110.31 in those 5 years. So your rate of return would be 111%. So by investing in the S&P 500 for 5 years, you're essentially doubling your money. So rather than £1,000, you've got £2,110.31. So investing in the S&P 500 is a nice, simple way to start investing, because you're basically getting exposure to those top 500 companies in America. So you've got a nice level of diversity within the S&P 500, and you're not having to think too much about the investment that you're making. So with this example, you're literally just investing that lump sum of £1,000, not investing anymore, and doubling your money over 5 years. Now let's just take this one step further. I'm going to talk to you about one of the investments that I currently hold, which is the Baillie Gifford American Fund. This is an actively managed fund, and it is considered more risky than investing in the S&P 500. However, with that higher level of risk, I have personally seen higher levels of returns. So the 5-year annualized returns for the Baillie Gifford American Fund are 31.9% per year. So if you had have invested £1,000 into the Baillie Gifford American Fund 5 years ago, you would now be looking at a pot of money of £4,845.57. So the total interest earned over that 5 years is £3,845.57, which is a total return in 5 years of 385%, which is obviously huge returns when you compare it to that 5% return that you are seeing with premium bonds. If you're potentially looking for higher levels of returns, then it might be worth considering investing. However, this does come obviously with higher risks. And now this perfectly brings me on to my second point, which is the length of time you're considering investing for and what you need that money for. So obviously with investing, it is very much swings and roundabouts. So there are big highs and there are big troughs. So yes, we've talked about that annualized return of the S&P 500 of 15% over the last 5 years. However, with investing, it is not always plain sailing, and you will see peaks and troughs in the market. So looking at the performance of the S&P 500 back in 2008 in the recession, the return for the S&P 500 was actually minus 38.49%. So if you are thinking about investing for the short term and investing for, say, less than 5 years, so say you invested for a year and you invested in that year, you would have lost 38.49% of your £1,000. So you'd have lost £384 in the space of the year if you were only holding on to your investments for the short term. So for me, if you are saving for something that you know is going to come up in the near future and you're not planning on investing for at least a couple of years, at least potentially 5 to 10 years, then I would say it's probably worth looking at something like premium bonds or a high interest savings account, because if you can't afford to ride out those troughs in the market and you need that money there and then perhaps investing isn't the right thing for you. So now let's look at premium bond allowances and investment ISA allowances. So you can invest anywhere from £25 all the way up to £50,000 in premium bonds. So it's capped at £50,000, you can't invest any more than that. However, with an investment ISA, you can invest £20,000 a year every single year. So you can start with obviously your £20,000, then the next year put another £20,000, so that moves your allowance up to £40,000. Then £20,000 the following year, so all the way up to £60,000, and obviously going forward in that manner. So you can have much more money invested in an investment ISA if you're willing to wait for those years to accumulate. Now, the reason that I choose to invest in an investment ISA is because that £20,000 and any gains from that £20,000 are all tax-free. So that is why I choose to invest personally in an investment ISA. But if you did have more than £20,000 to invest, you could invest your £20,000 into an investment ISA, and then any remainder you could look to invest it in a general investment account. But then obviously any gains from that might be subject to tax. So now let's get on to what I'm doing. So the majority of my money is invested in an investment ISA. I am comfortable with the level of risk and I do plan to hold onto my investments for 5 years or more. So that is why I feel most comfortable investing in that way. However, I do have a small pot of money in premium bonds, and this for me, I would say, is an emergency fund. If my husband and I were to lose our job and we had an emergency and needed the money, and at the same time the market was down and we didn't want to pull money out of our investments, then we have that money set aside in premium bonds that we can take out whenever we want for emergencies. So with investing, I personally think it's always really important to have some money set aside in cash or premium bonds or in a high interest savings account, just in case of emergency. The amount of money you have in your emergency fund can be so different for different people, and it also depends on how risky you are, whether you only want to have 1 month's expenses in an emergency fund, or some people have all the way up to 6 months. That's very personal, and I might make a separate video on that actually. Now, a few people might say, why don't you put your emergency fund into a high interest savings account? For me personally, I really like the idea of being able to potentially win £1 million tax-free, which is what happens with premium bonds. I don't play the lottery or anything like that, so it's my kind of I don't know, it's quite nice to think every month that you could dream and become a millionaire just like that. However, a high interest savings account is also a good option for an emergency fund as well. So yeah, I do hold premium bonds and investments as well. I think they are both amazing and definitely have their own function within my own personal finances. Now, if you'd like any more information or have any questions, then please do pop them in the comments down below. If I've missed anything, then please do let me know as well. Thank you so very much for taking the time to watch this video. I hope you found this video useful in some way, and I wish you all the very best with your investments. Bye bye.